Let's have a look at Henry Limited for 2021. It's the flexible budgeting question. So from section 3. So when we get flexible budgeting, they're going to give you an output levels at a certain percentage of output. So you've got 55%, 75% and 95%. It's going to give us the units that we're able to produce at each of that level. So when we're working at 55%, we're going to produce 27,500 units. When we're working at 75%, we're going to produce 37,500. And we're working 95%, we're going to produce 47,500. And then underneath each one of these then is going to tell us how much direct materials, wages, production overheads, other overheads and administration costs we're going to need, or the cost to produce this amount of units when we're working at this capacity or working at this output level. Piece of information here, profit is budgeted to be 20% of sales. We're going to use that later on as part of number 3 down here. So we've got two parts. A, we're going to have to look at our production overheads and separate them into fixed and variable cost. So that's going to be your production overheads here. You're going to separate our other overheads into fixed and variable costs. So other overheads here. Administration cost is already fixed because it's 38,500 for each of the percentages. So that means that your administration costs are not going to vary. And then when we come down to prepare flexible budgeting, we're also going to have to find out what is our variable cost for direct materials and direct wages. So direct materials and direct wages, they're going to be variable depending on how much material we're going to use and depending on how much employees we're using to produce those products or those units. So the first one, we're going to use the high-low method to calculate the fixed and variable cost. So we're going to take our variable cost, we're going to see what is the high in units. So 95%, the highest units we have is 47,500. Then we're going to see what is our low for our units. So our low then is going to be 27,500. I'm going to find the difference between the two of them, which is 20,000. And then the money term for high, so 47,500, we're looking at production overheads. So it's going to be 217,000. And for low then 27,500 for production overheads is 129,000. Then we're going to find the variable cost. So the variable cost is where we're going to divide the money, how much it costs us the difference, by the units, and that's going to tell us what is our variable cost per unit. So it's going to be 88,000 divided by 20,000. So we're going to get €4.44 for our variable cost per unit. So every time we produce a unit, our variable cost is going to increase by €4.40. Then to find your fixed costs, you're going to take your total costs. So this is this column here. And you're going to find the difference between your variable costs. And remember, fixed costs is equal to total cost is equal to your fixed cost plus your variable cost. So if we know what our total costs are, which is this 217,000 and 129,000, and we know what our variable cost is per unit, and we know how much our units are, we're able to calculate what is our variable cost per unit. So you can take this €4.40, you're going to multiply it by 47,500. So as we said, 475,000 multiplied by €4.40, that's going to give you a variable overhead for the production at 95%. And then your low, then you're going to take the 129. Same again, you're going to take the units, which is 227,500, and you're going to multiply that by €4.40, and that's going to give you 121,000. So 27,500 multiplied by €4.40. Those two are going to be taken away from each other to give you a fixed cost, which is 8,000. Now remember, if it's fixed, these two figures must be the same. So we've done our production overhead. We found the variable cost per unit, €4.40. That's using the high-low method. So you're taking the high in units, the high in money terms for those units. So 47,500. We're looking at production overheads. So we're using 217,000. And then your low then is going to be 27,500. We're separating production overheads, so it's 129,000. We're going to take these two away from each other. And then the 88,000 is going to be divided by your 20,000. That's going to give you a variable cost per unit, €4.40, and then the €4.40 is going to be used to find our fixed cost, which is your total cost is equal to fixed cost plus variable cost. So that means fixed cost is equal to total cost minus variable cost per unit. So your total cost, 217,000. Our variable cost is going to be your variable cost per unit, €4.40, multiplied by the units for that column. So 47,500. And then for the low, it's 129,000. The units are 27,500. So you multiply that by €4.40. And that's the first part. Separate your production overheads into your fixed costs, which are now 8,000 per unit, and our variable costs, which are €4.40 per unit.